streaming, and I'm going to start streaming here. And we'll just wait a second. And I believe we are live. So welcome back, everyone who's back, and welcome to everyone that's new to part 3 of Back to Basics, where we are taking a handful of trade ideas staffers who have never traded before and are interested in the markets, and we are going from absolute beginning of trading to hopefully very advanced using machine learning and artificial intelligence and back testing and all the cool stuff that trade ideas offers. So last week, basically, we went through the very beginning for what is a stock, right? The absolute basics as you can get. We kind of just determined that it's a percentage ownership in the company. It offers 3 ways to make money off it. One is buying it moving higher. One is holding it and getting dividends, which are payouts from the company on good earnings. And then the other is shorting it and moving lower. And then I just left everybody's picture there, so we'll just have a wave from everyone. And I'll do the introductions this time. So we have Marissa. Marissa can give us a little wave. She deals a lot with our affiliates and keeping everybody happy there. And we have Kelly, who's down there, and she's does a lot of the accounting and account works, and same with Shantae down below. And then Rudy's our design guy, and he's also the guy who makes these presentations way prettier than if I did them on my own. I feel like he face palms once a week when I'm like, this is what I've done. He's like, well, this looks like what a child would do, so let me make it look a little bit better. So today we're going to go through basically exchanges and markets. So we started with a little introduction to everyone and what we're doing. We then went into what is a stock, so what is it that we're actually going to trade, and now it's going to be how to actually trade it. There's a lot of people, to be honest, and just give me a nod if it's you as well, that if I said, okay, go buy a stock, you wouldn't have the ability to, and you probably wouldn't know how to actually hit the buttons to do it. So it's surprisingly common. And then also knowing things like, where's your order going, right? Where what's happening to my order when I hit buy? Where am I going to get filled? What's the price actually at? These things we're gonna talk about today. So we'll go through a bit of vocabulary and a bit of kind of what it is that happens when you place a trade, right? So first you have your order entry software. And quite often the order entry software and the broker are the same thing. But that's essentially the system that you click the button on that says you want to buy. In a lot of cases with our traders, it's they're 2 separate things. Like, for example, I trade almost exclusively through Brokerage Plus, which you guys will become familiar with. I'm sure you've heard many, many times the term, and I'll be showing you the ins and outs of that at some point. But that's essentially a software that I can click on our charts or any idea that Holly gives out or anything, and I say, okay, this is something I want to buy, and I want to buy this many, and I want to hold it for this long, and I know if I'm right if it gets to here, and I'm wrong if I get to here. All of that's done through your order entry software. So for us, that will be Brokerage Plus, and for a lot of people, it's whatever your broker gives you. So then it goes to your stockbroker, and then a lot of people actually think that's where your order is transacted at. So essentially with the stockbroker is actually kind of just the money man. So he's the one that manages the money that you have. You put in your couple $1,000, and he's the one that holds it for you. I have, along with AML, CTF here, which I'll talk about as a little bit, and then he pushes the orders to the exchange. So on top of taking your money, doing the simple math, like, okay, do you have enough money to buy this stock, or do you have enough money to short the stock? He also does a lot of AML and CTF, which stands for anti-money laundering and counter-terrorist funding. So I've done a bit of this in a past life as well. So has anyone seen Ozark? Is usually the best way I explain money laundering. Show of hands. Anyone? So that's exactly what they're trying to prevent against. So it's actually a very common way that people will try to launder money, where they will put their money into brokers, and they'll buy stocks and they'll sell stocks and they'll move stocks and move everything around, and then hopefully when they take the money back, it's clean. Just like they were doing in that show where he had all of this money, but you can't just take a briefcase of $100,000 and go buy a house, right? So you need to find a way to confuse the source of the money. So a lot of people will do that through brokers. So that's one thing that they do that is very, very important, to keep everybody safe. And, it's one of those unsung type things. So once they verified who you are as a trader and that you have the money and that you're not, a mobster or a terrorist or anything, they take your money and they hold on to it. And then when you send an order through your Brokerage Plus system, it goes to the broker, and then the broker sends it off to the exchange. So then what the exchange does is it takes all these orders from all the different brokers and it matches them based off of where the market is right now, which we're going to go a little bit further in just a second here. So equity markets. So there's marketplaces for all the different securities we talked about last week. We talked a little bit about stocks and bonds and options, and they all have their own different market types. So since we're going to be equity traders, we're going to focus on the equity markets, which is basically in the US, it's the NYSE, the NASDAQ, and the Amex. Those are the three big ones. I list pink sheets and OTCs as well, which is something that we'll talk about. But essentially the IPO, and this is what we talked about before on last week's, where a company is a private company and they're making money and then they want to go public. So what they do is they go to an exchange, let's use the NASDAQ for example, and they say, okay, I want to take my company public. And through a broker, what they'll do is they'll end up setting the shares aside and then they give them to the public so that the public will decide what the price is, right? There's some people out there that believe that exchanges have some sort of influence on price, but basically what they're doing is our second point here, where they're just connecting all of the buyers that are out there and then all of the sellers that are out there and seeing at what prices that they'll actually transact at. The other thing is dealing with counterparty risk. The other thing, and before I go on, I encourage everyone to unmute and ask any questions that you have as they happen, right? I have a tendency to ramble, so you'll have to interrupt me if you have anything, but essentially deals with counterparty risk. And what counterparty risk is the other side of the trade. So say, Rudy, you're going to go buy 100 shares of Apple. You don't want to have to go and find the guy you're buying it from and do all your due diligence to make sure he actually has the shares to give you and that it'll get transferred safely into your account and all of this. Because if you had to do this for every single transaction, it would be slow and monotonous and there would really be no markets to speak of. So what they do is they, through the brokers, let's take Interactive Brokers, for example, who is currently the only broker we connect with Brokerage Plus. They basically, the exchange, certifies that the broker is in good standing so that they know that any order that's being pushed from the broker, they don't have to check. They've done all the, they've checked the money, which we talked about in the last slide. They've done the AML, they've done the KYC. Everything there is good so that any order that comes from that broker can immediately be accepted and put into the market. So again, it's these little things that a lot of people, I know there's someone out there who's been trading for 10 years who really hasn't noticed or hasn't paid attention to this flow. And at the end of the day, what you're going to be doing is you're just going to be hitting a button and you're either going to get the shares or not. But it's important to understand everything that goes on behind. The other thing they do is they promote liquidity, which we can get talking about when we talk a little bit more about fees. But essentially what liquidity is when you go to buy something, is somebody there to sell, and vice versa. When you go to sell, someone's there to buy. All of us traders have been stuck in a liquid stocks where we were right. We bought a stock at $9 and it went to $9.50. So it was a great trade. And then we go to sell and there's nobody there. There's just no one there to sell to. So we end up sometimes being break even and sometimes for a large loss. It doesn't when you know what you're doing, essentially. It's like everybody who's done it's made a mistake. So one thing that Trade Ideas does very well is it we can filter out all the stocks that would do that and just not look at them at all, which is something we're going to talk about. But yeah, it has happened. Generally, there'll be a market maker to make sure that you're filled somewhere, but it's never at a good price, right? So what you want is a stock that's liquid enough, and liquid enough all depends on your size. So essentially the way I describe liquidity is eBay. So it's very important to note, and we'll go through auction market theory and everything in the next lesson. Essentially, it's important to note that all of this is an auction market. So essentially what an auction market is that there's really no one controlling it. If I want to buy something for $1 and Rudy wants to buy it for $5, and then Kelly wants to sell it for $10, I'm currently completely out of the running for taking the trade. If a sell happens because Rudy is offering or bidding for a lot higher price, he has to get the fill. So it all happens on order of who's selling or who's buying at the highest and who's selling at the lowest. And the more of that going on, that's more liquidity. And then the liquidity will change based off your size. If you're buying 100 shares, you're okay having a lot lower liquidity than someone buying 100,000 shares. And to go to another auction market that we've all at least heard of and used once or twice is eBay, right? That's essentially the same thing. So what a liquid market is if you're looking for a can of Monster on eBay. If there's only one out there, it's a limited edition or whatever, that's a very illiquid market because there's one guy who's looking to sell and he basically gets to control whatever price he wants to sell it on based on demand. A highly liquid market would be if there was thousands and thousands of cans of Monster. So if one guy's charging $1 billion for it, I know that someone else is going to charge a much lower price because it's liquid. And same when it comes to buyers. If I'm on the other side and I'm selling something on eBay, and there's a lot of buyers out there, then I know it's a liquid market and I could sell more of that item. If I'm making these, for example, whatever the widget is, I want a liquid market with a lot of people to transact at to make sure that I can do that as a fair price. The last thing that equity markets basically do is they deal with all the government regulation. There's certain rules about how things have to transact. For example, you can't have buyers and sellers out of order. So my example where Rudy was giving a lot better price in a market than I was, it's not possible for me to get filled before him, right? But if there wasn't that regulation, people could go and they could cut in line and move around, and these are games that used to be played. So the markets are subject to this government regulation. So it makes sure that we don't really have to pay attention to the government regulation because we can't physically do something that's wrong, if that makes sense, right? They stop you. If you're trying to do something that's illegal, the broker or the exchange will generally stop you before you do it, unless it's like insider trading or something to that effect. So yeah, the popular US exchanges. So a lot of these lines are getting blurred, so I'm going based off of a lot of my knowledge from when I was a more active scalper. The NYSE, generally a stock is on the NYSE if it has 3 letters or less. So you can go through and you can say, okay, Apple. Well, that's not generally an NYSE stock because it has more than 4 letters. Again, these rules are bending and breaking a little bit more than they used to. So Macy's is traded on the NYSE. Walmart is traded on the NYSE. Google is traded on the NASDAQ. And generally speaking, what happened in the past is the NYSE was a more prestigious exchange. It took stocks that only traded over a certain dollar amount. They had a certain amount of money in their pocket. They had they had higher reporting requirements, which I'm pretty sure is still a thing on the NYSE. They had to provide more data to the accountants. So it was a prestigious exchange. And then the NASDAQ was basically subjugated to the cheaper stocks. And that ended up being the tech stocks back in the day, where they would trade only technology companies. It's, again, the lines are getting blurred, but NASDAQ stocks will generally house a lot of the cheaper companies, a lot of the smaller companies that can't make it to the NYSE or just don't want to go through the hassle of reporting. Excuse me. The other thing is the NASDAQ is generally known as being a little bit more technologically advanced when it comes to how they trade. They were the first to be computerized. The NYSE followed suit pretty quickly, but they were kind of the leaders in technology. So basically the main way to know the difference is the difference between the symbol names. Generally speaking, nowadays it doesn't really matter. Back in the day, it really did. There was a while where I just would not trade NASDAQ stocks because I liked the slower ones that weren't quite as computerized as the ones that they are today. But now, as everything gets more computerized, it doesn't really matter too much. But it is important to know which exchange you're trading on, so you know how valid the company is, and that's where we're going to get to with the ones below. So the Amex is basically where your ETFs are traded. So a quick ETF lesson, which again I'm sure is something that a lot of you heard, is an ETF is essentially just like a mutual fund. It's just a basket of a bunch of stocks. You've probably heard of, correct me if I'm wrong, the SPY, right? That's a symbol you've probably seen a lot, in the QQQ. And basically the SPY is the S&P 500. So when you're watching the nightly news and they're saying the S&P 500 is up and down whatever amount, they're talking about the futures, but there's an ETF that tracks the same. So basically what it does, it buys one share or some percentage weight, I can't remember, of all of the top 500 stocks, and you can just trade that. And there's a lot of people that do. There's a lot of people that will look at that and say, okay, instead of me guessing on stocks, not knowing which ones are going to be the high performance and which ones are going to kind of die, I'm going to trade the market as a whole. So when people say the market, they're usually talking about some of these ETFs trade on the NASDAQ or the Amex. And you can do the same with oil and gas and gold and whatever have you. And you can do all that with Trade Ideas software. And then we have OTC and pink sheets. And these are essentially, an OTC market it removes a lot of that counterparty exposure where you don't really have to report that much to be on the OTC market. And I don't really need to know much about the broker. So it introduced that problem that I talked about where if I'm trading with Rudy, I need to be a little bit more concerned with who I'm trading with. And I put that this is where stocks go to die because it's generally for stocks that can't make the requirements to be on the other exchanges. So a suggestion I'm going to give you guys right off the bat, and again, we can list all this in the software when we start to set this up for you, is avoid those entirely, right? It's less liquid. They don't have the liquidity advantage that we talked about above. They don't really have the counterparty advantage. They're usually like penny stocks is there, which are a very dangerous instrument. So don't get scared, but this is essentially what the market is. And this is something I'm going to go, next one's going to be all about auction market theory and this kind of stuff. I know we're already crunching down on time a bit. So this is something we're going to go further in depth with because I think it's important. But basically, when people think of the market, they think of a chart. But what you're seeing right now is more or less what the market actually is. And I'll quickly go through. You guys can see my pointer, can't you? Yes? Okay. So over here on the right, this is all of the people. Sorry, the stock is SPY. It's not SPY, it's something else. But essentially, doesn't matter. Everybody over on this side are bidding for stock. So these are all the people that are looking to buy this stock. There's someone they're all at 50 cents and they're all using these different markets and brokers within the Amex, right? So this is where I was saying you don't really need to know the counterparty because they're all here and they're all been vetted and trusted. So this is all the people looking to buy. So they were, in my example, the people who are bidding $1 or $5 or $10 for whatever the instrument is. And then over here, you have all the people that are looking to sell, and they're trying to sell at 53 cents. And the same way, these are all the people who are offering this stock, and they're looking to sell that, right? Well, it could be you. So if you went and put through an order, and again, this is with it, this is an option, but it's the same for everything. So just you know, keep that in mind. But you could be, so right now there's one guy sitting here at 51, right? So this one guy who wants 6 shares is going to get filled if somebody sells way more than these. So if I went right now and put out an order at 51 cents, I would join this guy behind the lines, right? So it's all done through the broker, but with the flow we talked about earlier, it starts with you and then goes to the broker and then it goes here, right? So these are all individuals, corporations. You'll never know, and it really doesn't matter too much which one they are. So, and same, these are all the people that are selling, and this is called a level 2. We don't have one of these within Trade Ideas, and one of the main reasons is that there's a lot of games that can be played here, which we won't really talk about for a while later, but I just want to show you that this is the basics of the market. So over here is what they call the bid, and then over here is what they call the ask. So if I want to go right now and I want to buy this instrument and I want to get it right now, I don't want to wait in line behind these people, I want it right now, I have to pay 53 cents. And then if I want to sell it right now and I don't want to wait in line and I want the instrument right now, I have to sell it at 51 cents. So that's what they call the spread, right? So that's always going to be there in every single instrument. There will be some type of spread. And again, don't worry, we'll go in depth with this later. But just so you know that when it comes to how the market works, is you're going to route your order through your platform, through the broker, to the exchange, where you're going to be met with these real live other people that are also trying to bid and offer the stock. So this is how a price is derived, is, you know, this price will only move up when enough people get aggressive enough that they buy all of these shares that are offered here, and then it will move up a tick. That makes sense to everyone? Kind of? Yeah. Sorry? Oh, different of these? It depends on how liquid the stock is, right? Some will only have one or two. Some of them will have many. The main thing to keep in mind is it doesn't matter. You don't have to match up with these directly. So that's what the exchange does. So if I say I want to buy this at 53 cents, it's going to figure out whichever one of these guys was first in line. It's just going to match me up with them, and away they go. You can choose if you really want. There's really not much advantage to doing that anymore. That's another old game that used to die. And then this guy over here is just showing you what the last price is. So when someone says, you know, Apple's trading at $100, or this, for example, this is trading at 52 cents, because you can see the last trade that went through was at 52 cents. But that doesn't mean you can get that price, right? If you're buying, you can get 53, and if you're selling, you can get 51, right? So a lot of people think that you can just go from buying and selling all the time with no penalty, but you will always pay that spread. Unless you were willing to, if you wanted to sell at 53 and you were willing to get in the back of this massive line. And that comes to the order types, which we'll talk about here. So limit orders, which is what we're going to do kind of exclusively for your trading to start with, says buy me these shares at this price or lower. So in that example, if I wanted to buy right away, I could say, put me an order to buy at 53 cents. And what would happen is I would either get 53 cents lower than 53 cents if the market moves while I send my order, or nothing, right? If while I'm sending my order, the market moves up to 75 cents, I won't get any shares. So that's the limit order, which you can do through Brokerage Plus and is the safest way. Because while your order is in transit, even though nowadays it's only fractions of a second, the market can still move in that time. Market orders, buy me at any price. Just get me in. You know, these are more panic type orders. And then the other one is just a stop order, which says if a stock gets to this price, then I want you to buy me in. So, you know, I'm long Apple, and I'm long it at $102, and I say, if it breaks $100, get me out. I can send out an order that the broker will then hold and watch, and it will watch for the stock to hit that price, and then if it does, it'll get me out. And this is a lot of how people trade when they work, and you guys working in the trading industry, but not as traders yourself, will utilize a lot of these orders where you'll end up saying, I'm in this stock, I can't watch it constantly, so let me just send out this order and then have the broker watch it for me. And that's a good way to protect yourself, and it's also a good way to get into positions. If you say, I'm interested in Facebook, but only if it gets up to here, you can put in an order there as well to say, buy me when it gets to that price. So there's, think of this as a very passive type of order. You're saying, this is the price I want to pay. I will pay less, but I won't pay more. This is saying, get me in or get me out. I don't care what price. And this is saying, send an order to get me in, but only if you get to this certain price. So then these are the initial orders we're going to start with. And again, we're going to focus on the top one and the bottom one, and keep the middle one as kind of your holy crap button, I like to call it, right? Something crazy's happening and you just want to get out. That's what those orders are for. So this we're just going to go over briefly, because this is something that you guys have to deal with that I don't as a Canadian, so I'm not going to be too fluent on the laws, but it's definitely something that you guys have to consider. So in America, they don't think that you should be able to do whatever you want with your own money. So to trade more than, and again, someone will correct me if I'm wrong, 3 times a week for day trades, you have to have over $25,000 within an account. The reason they do this is because the trade, T+3, means it takes 3 days for the trade to settle. So I go and I buy Apple on a Monday. It's going to take Tuesday and then Wednesday before that actual shares are in my account and all parties have signed off that everything's okay. That's shrinking as technology gets quicker, but for now, that's just the way it is. So basically what we'll be doing for you guys to start with is something called swing trading, where you're going to buy a stock and you're going to hold it for a couple days, 3 to 5 days or a week, instead of in and out throughout the day. And that's because of this rule. There are ways around it, which we'll talk about again later when we talk about selecting brokers and all of that. And that is to trade with a prop firm, which is essentially a firm that takes a bunch of traders and pools them all together and uses kind of collective bargaining to get cheap rates and to assign risk to traders that are doing well versus traders that are doing bad. And then the other one is an offshore account, which I'm kind of weary about, but a lot of people use. If you ever heard of something like Shore Trader, they're an offshore entity. So this is something that you guys just have to know about and think about. I'm not going to talk to anyone's like local rules, but that's just going to kind of be a blocker that we're going to talk about later. But we still have months until I'm going to be comfortable with you guys trading anyway, so we'll figure that out when it comes to it. I'm just going to leave this screen up that has all of our to-do and everything. We are right on time, but I'm going to open it up. I know that was a lot, and it was because just talking about exchanges was too little, and then just doing auction markets, that might take 2 or 3 lessons, so don't worry, I'll go over that as well. But this is the Q&A time, so any questions from anyone? Yep. Sorry. So your platform, so the order entry platform will actually tell you what the current price is. So within Trade Ideas, you can actually, and within Brokerage Plus, which is a useful tool, it will bring in those 2 prices that we showed here. So it won't show you all of this because, this is something that you needed to know way back in the day, but there's all sorts of ways you can hide orders and dark pools and all kinds of crazy stuff that we'll talk about. But what Trade Ideas will show you through Brokerage Plus is what is the best the lowest ask price, and then what is the highest bid price. So it will show you that, so you'll know exactly what price to enter at. And then, a lot of people, what they'll do is they'll use their chart and they'll say, okay, this is the area that I want to get in, and this is roughly where it's paying now. So what they'll do is they'll send out a limit order to say, give me this, or maybe a little bit above. So in this case, they might send out a 55-cent limit, which means they'll get filled at 53, 54, or 55. But if it moves further than that, by the time the order's sent, they just won't get any. That make sense? No problem. Yeah. Not that you would notice. There is kind of internally. The fee structure of the different exchanges are a little bit different. Most brokers, they'll just charge you a flat fee for a trade, so you won't really have to worry about it too much. But it's one of those things that back in the day it was a big difference, but now that both exchanges are becoming very technologically advanced, it doesn't really matter too much. What I'll just say is note that the New York Stock Exchange and the NASDAQ is where kind of real companies will trade, and then the those OTC and pink sheets, not so much. So again, one of the beauties of trade ideas, just like we were talking about with Rudy and his liquidity question, we can just say, don't show me those, right? So what you'll be looking at will only be the exchanges that we're interested in to start with. So other than that, you don't really need to pay too much attention to them. No problem. Anyone else? Any other questions? No? Okay. So we're on a run, and we're going to try to keep it that way. So, if you enjoyed the stream, again, I know for a lot of you people who follow us, you're going to be traders anyway, so this is going to be a bit basics, but we're going to go through auction market theory, and then technical analysis and statistical analysis and psychology, and then we're going to talk about building a trading plan, and then how to take that trading plan you built and how to scan for it within trade ideas, and then a bit on how to auto trade it. So we're going way out there. We're just kind of getting warmed up. So I don't want anyone to think that this is too basic, because it's going to get pretty crazy pretty quick. So I hope you guys are ready as well. I'll try to space things out and go slow enough that it makes sense. But again, thank you all for coming, and thank the internet for coming, and we'll see you next week. No problem. Bye-bye.